In this video, we're going to talk about Matterport, trading under the ticker symbol MTTR. At the moment, the financial market is very volatile, and we should be careful about which stocks to buy and the exposure and their timings. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is usually based on sessions already completed. If there are significant events happening afterwards, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock decreased to $7.48 before closing the trading day at $7.30. We should pay attention to the $7 level nearby because it was tested as a support level in the short term, below which the retracement may accelerate even further. It's interesting to note that if we look at the price trends, it should remain above $6.60 or so in order to remain in the bullish run. Over the past 30 days, the trend of the stock has been bullish, even if at the moment the limits are getting tested. From the perspective of a month, the stock has been up by just 3% over the course of the past 30 days, and I believe that it should be resumed in the near future. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish, as the stock lost more than 60% of its value, but stabilized since the beginning of the year, and it is now looking for catalysts to move up once again. When we look at the price trend overall, it's been slowing down, but this is probably because the stock is now regrouping and allowing some shareholders to readjust their exposures in the stock, which can be considered as normal for the time being. The trading volume of Matterport has recently been 5.6 million shares versus the average volume of 7.7 million shares. Over the previous 52-week period, its price fluctuated between $5.71 and $37.60. The market cap of Matterport is currently at $2 billion compared to the enterprise value of $2.4 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to give to the company based on the fundamentals, the leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image amongst market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation on the market every time it publishes its financial statements, so it's less reactive than the market cap and often more lenient as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that a company can generate more profit or grow faster than its competitors, partially because it may have a better management, a stronger brand recognition, and a bigger online following. It is what makes a company unique compared to the competitors. In other words, it's not a tangible asset that companies may use, but it's often the reason why some companies are perceived to be trading at a discount. When we compare the current price to its historical price fluctuations, the stock is 12% higher than the 1-month low, 26% higher than the 3-month low, and 26% higher than the 52-week low. On the options market, which often gives a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 104% versus a historical volatility of 86%. The put-call volume ratio is currently at 0.49. It's normal for many stocks to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 3.6 thousand contracts versus the 30-day average of 8.3 thousand. For the open interest, the most recent volume of open interest is 165,000 contracts versus the 30-day average of 185,000 contracts. As for the shareholder structure, institutional owners hold about 6.4% of the current float. The biggest shareholders include Fidelity, Vanguard, and Schwab. It's relevant to understand the shareholder composition because it helps us to determine if you should be holding the stock for the long term or to simply trade it for the short term. If the stock is mainly held by retail traders, this is a sign that the stock may lack the depth to justify long-term trust from shareholders. Typically, the consensus is between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously lots of exceptions to this, since many great titles are also mostly held by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, if there are significant short interest in the total volume, this is a sign that there may be organized shorting operations going on, like what is going on with GameStop and AMC. The current short interest is 12% of the total float and 54% of the transactions coming out of the dark pools. Overall, my opinion on Matterport is bullish because the stock is currently located in a very interesting price level, and I believe that the downside is quite limited compared to the upside. If the stock has been able to hold the line during more difficult periods, I think that it's also going to be able to hold the support level now. The maximum exposure I would therefore recommend is between 1 to 3% of your portfolio. And for the immediate term, my recommendation is to buy the stock, considering that the recent price actions and the promising price levels are close to where the stock is right now. I would recommend to separate your allocation in batches of 20% at a time so that you may have enough room for later purchases. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.